You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
It's good to be back, Jim. You know, it's quiet out there today in the markets, and this is a good time, I think, to plan strategy and get ready to act.
Well, today we'll be talking about will gold, silver, and miners leave you behind, runaways versus breakouts, and people who wait just too darn long to jump in and play. Well, first of all, will gold, silver, and miners leave you behind?
That's a real question a person has to ask themselves. Number one, if they have not taken a position at all this late in the game, and number two, if they don't have all that they want in terms of their positions and they keep holding off to wait till prices go where they expected and then try to jump in, which is not the best strategy.
Well, first of all, gold, silver doing very well. Palladium has moved up. And, of course, junior miners who have been ignored for now, it looks like about 2 years. Finally, people are paying attention and taking a look and trying to pick the best. How do you pick the best?
Well, you know, the Morgan Report, virtually the entire team on the Morgan Report has been beating the drum on the PGMs for the past 2 years. You know, we've discussed properties we've visited, we've talked about the charts, we've talked about the supply-demand issues, and now finally, as you mentioned, Palladium made a major breakout last week from a several-year ascending triangle, and it looks to be valid at this point. And so we're probably going to see higher precious metals prices for a long time to come. The hard thing is that a lot of people waited to do anything before they saw this, and now they're asking themselves, well, gee, I didn't buy palladium at $720, and now it's almost $100 higher. What do I do? And so the thing is, you've got to work your strategy so that it makes sense to you emotionally and financially, but you can't wait until prices go where you've expected them to go and then to think that you're going to be able to take a position and make some money. So the key, in my view, is to look at your technical indicators and do your research and wait till those things point you in the right direction that you feel comfortable, but don't wait until everybody's saying the same thing that you believe in, and don't wait until prices have made a giant move before you do something. Buy in tranches or portions, and buy into weakness whenever possible.
How do people know when that's the right position?
Well, they look at the long-term charts and they look at the market action and things like this, and they try to be a little bit of a contrarian. And if they still feel that this is the right thing for them to do, then they take a position. And what I find is if a person is afraid the market's going to get away from them, then they should take a portion of their position as soon as they're ready to get started. And they may pay a little bit more than they'd like in retrospect for that, but at least they'll have that position. And if it is a market that's not going to turn around and look back, they're not standing at the gate with nothing. They at least have something, and that helps them to remain a little bit calmer and also to possibly wait for a retracement where they can get the rest of their position.
We've always advised never go all in, because everybody who does that, I think, I would say about 90% of the time, that was the wrong thing to do. So is this the time to go all in?
I don't think so. I think we still have a large trading formation going on, even if gold and silver go substantially higher before correcting. I think they're going to form a very large trading range probably until late summer. And it's hard to say exactly where that top's going to be, but it would be kind of surprising to see gold go up and challenge the 1,500 area over the next few months. But silver could rise several more dollars, and you could still have a very large range which would give you a chance to add to your position on weakness, especially with the different mining stocks. Another thing I find that people make a mistake in is they expect everything to move at the same time. They expect gold, silver, platinum, and palladium to be all moving upward on the same day, and sometimes one or more of these metals just sit there and don't do much of anything. And so if that's the metal you're looking at, then that's your opportunity rather than saying, well, maybe something's wrong. The same thing with the mining stocks. You know, do your research and develop confidence that you're making good choices, and then wait for an opportunity when you can get in at a price that you're comfortable with, and ideally is one that's lower than if you had just jumped in all in, as you say.
David, we're talking about runaways and breakouts. Maybe explain the difference between runaways and breakouts.
Well, a breakout can lead to a runaway, and essentially it's where prices move above an area that they haven't been able to go for quite some time, and they just take off and they don't look back. And the most interesting one that I've noticed lately has been the coffee market, which has virtually doubled in price over the last, probably just the last month or so. And prices broke out very strongly out of a trading range. They form what's known as a bull flag, where you have this flagpole. Prices decline for about a week into a kind of an unfurling of the flag, and then they take off again. And the measuring of that is is the length of the flagpole added to the breakout of the new uptrend. And this is coffee has made several of these, and one that I follow is an ETF called JO for kind of a play on words, but that's a ticker symbol, Joe the coffee, but this is just JO, not JOE. And it's doubled in price. And so now, people, let's get into coffee, but look what's happened. 2/3 of the potential move has already taken place. But you could have bought the breakout. Ideally, you would have bought and held when it was not breaking out, but you felt coffee had upside potential, with, say, 1/3 of your position. Then you could have bought another 1/3 on the breakout, and then maybe your last 1/3 never got filled at all. But most of the time we do not see runaway markets. They act like they're going to, and then they'll come back and they'll challenge that place where they broke out, which is called kissing that level, just barely touching it. They may barely touch it. They may not quite touch it. They may even dip down into where they came out of, which causes a lot of fear for the bulls. And then if it's valid on the move, they'll turn around, go right back up, and then they won't look back again there for a long, long time, sometimes months or years.
Right. So this is a market that you think coffee, we're not giving advice here, but because so many people jumped in and it went so fast, all the good opportunities are gone?
Well, a lot of the potential profit's not there. I mean, ask yourself, is it going to double again right away? Well, maybe, or even over the next couple of years. We don't know that. It looks like coffee is going to be higher price for quite some time because of the El Nino effect and some of the growing areas. But the point being is, a person thought coffee was going to do that, and now they don't have a position at all. But if they had accepted a little more risk and bought when prices were quiet, they'd have at least part of the position, and whatever they have, they would have now doubled their money within less than about 6 weeks.
People are asking, why is palladium making this big play right now?
Well, all of these supply-demand fundamentals are pointing in the direction of reduced supplies of palladium with increased applications, and also applications that once were the purvey of platinum, but now they're finding that palladium can do just as good of a job and it costs half as much. So it's going to be a fascinating market to watch, and it's too bad that a person maybe didn't buy $100 lower or even $200 lower a year and a half ago, but those prices are gone and they're probably not going to come back. So you just have to watch for an area of weakness, maybe put in what's called a stink bid, which is lower than you think it's going to go on a given day, and you might get filled. I've done this a lot with mining stocks, ones that I really wanted but didn't want to pay so much for, and out of nowhere, a big order gets dumped one day and the price goes down for 20 minutes, and sometimes it hits my order that I put in good till canceled. So those things can be very powerful. Another one I did a few weeks ago was a Chinese jewelry company that has a lot of jewelry sales on mainland of China and Hong Kong. And it was I wanted it about 10% lower than it was trading. And so I put this order in with a limit order, good till canceled. It took about 2.5, 3 weeks, and lo and behold, I got filled. And now it's turned around and gone back up, and I have about a 10% paper profit. So that makes me feel really good, and it makes me feel relaxed. And that's what you want to do. Try to do things that help you to be relaxed in a market that is otherwise very, very emotional.
How do you keep your emotions in check?
By doing that sort of thing, by not going all in, by not thinking that I can predict where prices go, but watching what the market action tells me and see if I can understand what Mr. Market is saying. Sometimes I don't get the message right, but sometimes I do, and over time I keep trying to do a better job of it. But also, the main thing is to not get caught up in all of that fear and greed that goes on in the market so that you just become tossed around like a cork on the waves.
Try to keep your head and other people are losing theirs.
Exactly.
Thanks a lot for chatting with us, David.
Very good, Jim. It's been great talking with you.
My guest has been David Smith, Senior Analyst for the Morgan Report. You're listening to HowStreet.com Radio. Find us on Twitter or Talk Digital Net. You can contact us at info@HowStreet.com. I'm Jim Goddard.